Dakota CLE. I'm a member of the South Dakota CLE Committee. I also work in Rapid City for Anchor Law Group. Before we get started, there's just a couple of things I'd like to go over. Do you or a lawyer or law student you know have a drug or alcohol problem or are struggling with depression or anxiety? Lawyers Concerned for Lawyers is a confidential and independent resource for South Dakota lawyers, law students, and their families. Your referral or visit with LCL is strictly confidential and privileged. You may call Becky Porter for more information at 605-391-5191. Becky is a member of LCL, and your communications with her are confidential and privileged. South Dakota State Bar members and their families also have access to Sand Creek Member Assistance Program, which includes a 24/7 hotline. To reach a trained professional at any hour for a confidential discussion and assessment, please call Sand Creek at 1-888-243-5744. Today's presentation will last approximately 1 hour. You'll have the opportunity to submit questions to today's presenter by typing your questions into the chat pane. Excuse me. You may send your questions at any time during the presentation. We will collect these and address them during the Q&A session at the end of today's presentation. I'd like to thank the State Bar of South Dakota and CLE Inc. for their support of today's program. And now I would like to introduce our presenter. Carrie Christensen is our presenter today. She joined Cato Thorstensen in Rapid City in 2013 and is a manager in the tax department of the Rapid City office. She works with individuals and businesses from all industries, including construction, medical, and other professional service businesses. She also has experience communicating with the IRS and can assist in resolving IRS issues. I'd like to thank Carrie for presenting today on tax issues that lawyers should know. And with that, I'd turn it over to Carrie.
Good morning or good afternoon if you're in different time zones. I'd like to start off by saying thank you for sharing your lunch hour with me and allowing me to share some tax tips with you today. I've compiled a few topics that I felt would be interesting to you personally, and then some topics that might be relevant to your clients. I'd like to start off by saying that for every tax problem, there is a solution which is straightforward, uncomplicated, and wrong. We know that tax is a complicated area and just seems to be getting more complex every year with all of the new legislation and credits, and just every year it's changing. So hopefully you can find a few tips today that will provide useful to you and maybe your clients as well. I'd like to start off with reminding you about the 100% meals deduction. So this is a nice benefit. It was in place for 2021 and continues for 2022. This deduction is available for business meals that you incur, either taking clients out or eating with a colleague or a referral source. As long as you're talking business, this would be 100% deductible if it's provided by a restaurant. You do not have to eat at the restaurant either. You can take the meal to go and you can eat it back at your office and you still get the 100% deduction. In previous years, it was only 50% deductible. And I do want to point out that if you get food from a grocery store or convenience store, you're only going to receive a 50% deduction on those meals. And the per diem, the IRS has a per diem rate that you can use for business or travel meals instead of your actual costs. And this will also be 100% deductible. Currently, the rate is $64 per day in this area. There are certain areas that the IRS has deemed high cost locales, and those meals would be $74 a day. The IRS has a chart that you could look if you needed to see if the area you were traveling to would qualify for the higher cost locale. I'd like to move on to a few tax saving tips, some deductions that you might be able to use to offset your business income that you receive. So this first slide would be inclusive for self-employed attorneys and attorneys that are also partners in a firm. The first one is the home office deduction. This has been around for a while. There are two ways that it can be calculated. There is the simple method and the actual cost method. And for either method, the qualification to take the deduction would be that you have an area in your home that you use regularly and exclusively for business. Now, it doesn't have to be a whole room. It could be a portion of the room. That's totally acceptable. The simplified method is calculated by taking your square footage of your office space and multiplying that by $5 a square foot. The actual cost method involves getting a percentage using your home office area versus your square footage of your entire home. You then take that percentage and multiply it by the various expenses that you incur to maintain your home. So these expenses would include items such as your mortgage interest or rent, if you rent, your real estate taxes, home insurance, utilities, repairs and maintenance, and also a portion of the depreciation, so the cost of your home. One we see quite often when we're preparing tax returns for attorneys is unreimbursed partner expenses. There are a multitude of expenses you may incur that you are not reimbursed by your firm. So it's good to track these so that you can get the deduction at tax time. A few of these would be business meals, as I discussed earlier, which you would get 100% deduction for 2021 and 2022. And also travel expenses. So you can use the standard mileage rate or actual cost of your vehicle. The 2021 standard mileage rate is 56 cents per mile, and for 2022, it's 58.5 cents per mile. Other common expenses you might have would be your cell phone, your internet, your continuing education expenses, professional fees such as the cost to have your tax return prepared. Those are the most common ones that we see. Third, so if you finance your buy-in to the partnership, you are eligible to deduct the interest that you pay on that buy-in loan to offset your business income. And then any self-employed health insurance payments or retirement contributions you make, those are also deductible to offset that business income. Moving on to options available for attorneys working as employees. There are much fewer options for employees than there are for self-employed individuals, which is the same for any profession. Prior to the Tax Cuts and Jobs Act of 2017, employees that were able to itemize could deduct their unreimbursed employee expenses as an itemized deduction, but that went away beginning in tax year 2018. One option to consider to still get these costs deducted would be to have the employer set up an accountable reimbursement plan. So with this, the employer could reimburse the employee and the employer would get the deduction and the employee would not have to pay income tax on that benefit. And then finally, just take advantage of any of the pre-tax benefits that you're offered as an employee. These could be things like health insurance, retirement contributions, HSA, FSA plans if your employer offers those. So any of those pre-tax benefits will reduce the amount of income that is on your W-2 and will reduce the amount of income tax you end up paying. Moving on to the question as to when are attorney fees deductible? So as I mentioned earlier, the Tax Cuts and Jobs Act went away with certain deductions that taxpayers used to be able to itemize. And another one of these were attorney fees related to personal investment issues. This used to be deductible as a 2% itemized deduction. This is no longer allowed. But it should be noted that if the fees that your clients are paying are related to issues involving their business or their rental properties or farming issues, any of those, they're still going to be able to write off directly against that business income. And just a little bit more on attorney fees. The IRS does have a carve out for something called, we like to refer to it as an above the line deduction. And this basically means that your client is not paying tax on the fees they pay to you because they're able to write off the fees for certain types of cases as a deduction before arriving at taxable income. I honestly don't know if these are cases that you see a lot around here, but these are just the ones that the IRS has specifically said would qualify for this carve out for the above the line deduction. So those are listed there. And then they do have a few more. So these acts, there are certain provisions that the IRS will allow that deduction as an above the line deduction. And moving on to step up in basis, I'm sure that you are all familiar with step up in basis, but I just wanted to briefly touch on this because it has been in the news lately when Biden was originally proposing this to eliminate this as an opportunity to increase tax revenue. Of course, it hasn't gone through and we honestly don't think it will, but it's a concept to be cognizant of, and it's really relevant to our clients that have assets that have appreciated in value over the years, such as land, buildings, stocks. So just to briefly touch on what the step up in basis means, it means that when a taxpayer dies and their heirs inherit these appreciated assets, they get the fair market value at date of death versus inheriting the lower cost basis that the individual originally paid for the asset. So by having the step up in basis in the tax code, it reduces capital gains that our clients pay. So it's really a benefit to our clients. We would never want to see this go away. One other thing I wanted to point out is that now that the joint estate exemption is over $24 million, a lot of our clients, or many of our clients that used to have estate tax issues do not. So as we're advising our clients, you know, if they don't have an estate issue, it's maybe not a good idea to do lifetime gifts of appreciated assets. May want to consider having them inherit those assets so they get the step up in basis. And just one more point on this is a way to increase valuations at date of death for partnership interests that are inherited would be the way these entities are structured. So LLP general partnerships and member managed LLCs will have higher valuations at date of death than entities that are structured as manager managed LLCs or limited partnerships. Paul Thorstensen at our office does valuations. So if you have more questions relating to these types of entity structures and how that the valuations and date of death works, he is definitely a good resource for that. A quick example on how having the step up in basis saves our clients tax dollars. So for example, say land was purchased in 1920 for $100,000. In 2022, this landowner dies and it's worth $1 million. The heir receives the land, it's worth $1 million, that's the basis they get in the land. They could turn around the next day and sell that land for $1 million and pay no income tax. If we didn't have this step up in basis, they would have a $900,000 long-term capital gain. They could pay up to almost $215,000 in tax. Long-term capital gain rate, the highest rate right now is 20%, and it could potentially be subject to the 3.8% net investment income tax as well. This applies to capital gains that are not from a trade or business. So moving on, I have 10 tips on taxation of legal settlements to share with you. Tip number 1 is that settlements and judgments are taxed the same. So it doesn't matter if you settle out of court, or if you just reach the letter writing stage, or if you have a full trial and reach a judgment, the monies are going to be taxed the same to your client. Tip number 2 is that taxes depend on the origin of the claim. So to determine the taxability of an award, you would ask the question, why was this money awarded? What was the award? What was the remedy? Just a few examples here is that if the plaintiff is suing a competing business for lost profits, that's going to be ordinary income if they receive that, because if they would have received the income, it would have been ordinary income. If a plaintiff is suing an employer for being laid off for discrimination, this is wages. They'll receive a W-2. It'll have federal withholding, Social Security and Medicare, just like a regular W-2 would. Another example is if the plaintiff is suing a contractor for damages to their home that's being built. This would generally not be considered income, but it would reduce the cost basis in the home. So it could play in later on if the home was sold, they'd have a lower basis to offset the sales price. Tax tip number 3 is recoveries for personal physical injuries and physical sickness are tax-free. So money received to compensate injuries from accidents, car accidents, falls, those are going to be tax-free, but the IRS wants to see cuts and bruises to prove that it's physical. It's often disputed. Maybe some of you have seen cases like this. I want to point out that from what I've read, that sexual harassment cases often don't rise to the level of physical sickness. They're often classified as emotional symptoms of emotional distress, those types of cases. Which leads me to tip number 4, which is that symptoms of emotional distress are not physical. So if the plaintiff has headaches, stomach aches, those are symptoms of emotional distress and are not considered a physical sickness or injury, and those would be taxable. It's a gray area. What if your client has developed an ulcer from the sexual harassment that they received from their employer? Is this a physical sickness now? I don't know. That's something you'd have to argue for your client, but it is in your client's best interest to make the argument that it's physical sickness versus a symptom of emotional distress, because one is taxable and one isn't. So they'll have more money in their pocket if you can argue that it's a physical sickness. Tax tip number 5 is that medical expenses are tax-free. So medical expenses, money is awarded to your client that is reimbursing them for medical expenses they've incurred. They're not going to have to pay tax on this money. This doesn't just have to be expenses paid to a physician. It can be multiple types of medical professionals. And I do want to mention that if the taxpayer has previously deducted these expenses, for example, they had enough medical expenses to be able to itemize and they got the tax deduction for that and later received that money back, then in that case, it would be taxable. Tax tip number 6 is allocating damages can save taxes. I'm sure most of you are aware that your cases are going to have multiple types of awards from one case. You can argue and make an allocation as to what is paid, how the money is broken out to the different types of awards. And it's in your client's best interest to have more dollars allocated to tax-free types of awards versus taxable. And the IRS does usually honor these allocations. Just to throw out some examples here, if they're wages, they're going to be reported on W-2 as taxable. Emotional distress, like we discussed earlier, is going to be taxable, and it's going to be reported on a 1099 to the client. Reimbursed business expenses would generally be non-taxable. Physical injuries, non-taxable. Punitive damages are always taxable. Tax tip number 7 is look for capital gains instead of ordinary income. If there's a way to structure the settlement so that it's considered capital gain, your client's going to pay less tax. Current long-term capital gains rates range from 0 to 20% based on the income tax bracket that the taxpayer is in. They could be subject to an additional 3.8% net investment income tax, depending. This goes into play when taxable income is over $250,000 for joint filers and $200,000 for singles, whereas the ordinary income tax rate can be as high as 37%. So a lot of settlements that are related to real estate cases, those may fall into where they can be taxed as capital gain, or it could be that the settlement is simply treated as a recovery of basis for the building that was damaged. In this case, they would not have to pay any tax on that income in the year received. They might be able to just reduce the basis in the property. So down the road, this would increase gain because they would have a lower basis to offset proceeds. But during the year they received, if they're able to reduce the basis, they're not going to have to pick that up as income in that year. And also some patent cases can produce capital gain. Tax tip number 8 is that attorney fees can be a trap. So your clients might not be aware that they cannot deduct all of the fees they pay you. If the case is business related, they're going to be able to deduct the fees, but in certain other cases, they might not be able to. So for example, say your client is awarded $100,000 for emotional distress and you charge them $40,000 and they only receive $60,000, they still have to pay tax on $100,000. That might be a bit of a surprise to them. Tax tip number 9 is that punitive damages and interest are always taxable. So even if the case is for physical injury or sickness, if there are punitive damages that are also awarded, that portion of the award will be taxable. And any interest on any type of settlement will be taxable as well. So one thing you could consider, even a lower award that is not structured as more non-taxable could leave your client with more money than a higher settlement that's taxable. So just an example here is that, so say it's a $2 million tax-free settlement, that might be better than $50,000 that's tax-free, and then punitive damages of $5 million, because they're going to pay more tax on that. So just something to think about there. Tax tip number 10 is it pays to consider the defense. The defendant is going to want to be able to write off all of the attorney fees they pay. If it's business related, they're going to be able to do that, no problem. Even for punitive damages, they're able to deduct those. One thing to think about, as we discussed previously, real estate settlements, the fees may need to be capitalized. So they might have to capitalize your fee and depreciate it over a number of years rather than being able to deduct it all in 1 year if it's related to those real estate disputes. Moving on to another topic that I found quite interesting is related to insurance bad faith recoveries. So you're probably familiar with these, but a question that comes up is, are they taxable? The answer is, as many things, it depends. The IRS covers this in Section 104, the Internal Revenue Code, and that's on compensation for injuries or sickness. So some questions that would need to be considered when determining if the insurance bad faith recovery is taxable or not are the origin of the claim. Why were the funds paid out? What was the original source of the dispute? Is the recovery from physical injury or sickness? If the answer is yes, this recovery would likely not be taxable. Who paid the premiums on the insurance policy? If the employer paid the premiums and the employee gets the recovery, it's likely going to be taxable to the employee. Is the recovered amount within or in excess of the policy limits? Amounts recovered that are in excess are typically taxable. I have a few examples to share with you on insurance bad faith recoveries. The first one is an Irs Private Letter Ruling from 2009. And I just want to point out that private letter rulings are not considered authoritative, but can provide guidance for taxes. So the facts of the case here are that there was a construction worker that was struck on the job by a drunk driver. The drunk driver was a tavern manager who was drinking on the job, left his job, and subsequently hit the construction worker. The construction worker was injured, was not able to perform his job, so he sued the tavern and the tavern manager. He sued for compensatory damages such as physical injuries, medical expenses, pain and suffering, lost earnings, and he also sued for punitive damages. He was awarded X dollars in compensatory damages and Y dollars in punitive damages. The defendants appealed. An important part of the case was that the tavern's insurance company was offered to settle up to the policy limits. The insurance company declined this opportunity, and this allowed the tavern to bring a bad faith claim against the insurance policy. So what happened next is that the tavern ended up assigning the right to the bad faith insurance claim to the plaintiff. So the plaintiff subsequently went after the insurance company for the bad faith claim, and the insurance company settled, and the plaintiff was awarded Z dollars. Question here is, was the bad faith recovery taxable or non-taxable? The IRS looked at Section 104 and specifically the origin of the claim. So the plaintiff would not have received, the IRS ruled that the money was non-taxable because the origin of the claim was that it stemmed from physical injuries due to the drunk driving accident. But remember that the plaintiff sued for compensatory and also punitive damages. In the private letter ruling, the IRS did specify that any amounts allocated to punitive damages would be taxable, but they didn't offer any opinion on how those monies would be allocated. So after this private letter ruling came out, many taxpayers tried to make the claim that bad faith insurance recoveries are simply tax-free, but that's not always the case. So I have another example to share with you here. This one is Sains versus Commissioner. This was a 2014 tax court summary opinion. So the facts of this case, Sains was employed by a community college in California, and his employer offered long-term disability insurance as an employee benefit. Sains did not pay the premiums, the employer paid them, and they were not included in his income. While Sains was employed for the community college, he developed Bell's palsy, which made him unable to work. Interesting fact is that my mom developed Bell's palsy when she visited me a few years ago, and we thought she was having a stroke or something, but it turned out it was Bell's palsy, and she was perfectly fine a couple weeks later. But however, Sains felt he was disabled, that he could not work, so he sued. First he filed for long-term disability payments, and the insurance company denied those. So subsequently, he filed a bad faith insurance claim against the insurance company, and it was eventually settled for $65,000. Question again is the $65,000 taxable or non-taxable? In this case, Sains tried two different arguments to argue that the money awarded was tax-free. He first decided to argue that it was for a physical sickness, so the money should not be taxable to him. When that didn't work, he said it was essentially workman's comp payment, which shouldn't be taxable to him either. The court denied both of his arguments, and the reason was because Sains did not pay the premiums on the long-term disability. His employer paid it. So the money, if he would have received the original long-term disability payments that he had filed for, those would have been taxable income to him. And so in the same manner, going back to origin of the claim, the money received through the insurance bad faith recovery is also going to be taxable to him. It's very hard for claimants to prove that insurance companies actually cause them physical harm. One more final example on this, just because I find them so interesting. So this last one is the case from 2010. This is Hoff versus Pedersen. So in this case, Hoff was hit by another driver that had no insurance, and he suffered physical injuries, which did not allow him to work. So he requested compensation for his lost wages. The insurance company agreed to pay him the lost wages, but they only agreed to pay net wages, net of the income tax. Hoff did not like that he was only receiving the net amount. Hoff wanted the gross amount. So Hoff then sued the insurance company for bad faith, saying that he should be paid the gross amount of lost wages. In this case, the court determined that the insurance company was not acting in bad faith by paying the net amount, because the funds that were paid to Hoff would have been considered for physical injury. They would not have been taxable to him. So by paying the net amount, he was made whole. If he would have been paid the gross amount, he wouldn't have to pay tax on those, and that would have been in excess of the recovery. I just have a painful tax example to share with you, just to kind of reiterate how taxes and attorney fees do really decrease the amount of dollars that the client walks away with. In this example, the client is awarded $1 million for emotional distress. As we discussed earlier, emotional distress is going to be taxable. This puts them in the highest tax bracket, so they're paying 37% income tax on this. There's $370,000 out the door. Say you charge them 40%, there's another $400,000, and they can't deduct that. They walk away with $230,000. And that's in South Dakota. What if they're in a state like California or Minnesota, where there's high state income taxes. They're going to lose even less of that. And of course, there's also that pesky 3.8% net investment income tax that could potentially come into play and take a little bit more of those dollars away from them. And I just have one final thing to leave you with. It's how to avoid an IRS audit. This is a quote from Jay Leno. Worried about an IRS audit? Avoid what's called a red flag. That's something the IRS always looks for. For example, say you have some money left in your bank account after paying taxes. That's a red flag. That's all I have. So any questions?
Thank you, Carrie. If anyone has any questions, you can enter them to the chat pane now. Okay, I'm not seeing any questions being entered. So again, I want to thank you, Carrie, for presenting today. If any of those, I'm sorry.
I just said thank you.
Yes. If any of those in attendance have any additional questions after today's webinar, you can contact the State Bar at info@sdbar.net, and we will forward those on to Carrie and get answers for those questions. Once you leave today's webinar, you will receive a survey on the presentation, and we would appreciate it if you would complete that and send that back. Your feedback is very helpful to the CLE committee to make sure that we are providing programming that is beneficial to our bar. Then again, on behalf of the State Bar of South Dakota and the CLE committee, I want to thank you for joining us today, and I hope that you have a great rest of your day.